Today's briefing focuses on the strategic positioning within the Korean equities market, currently characterized by a severe macro-micro collision. The Korean market uniquely operates as a high beta proxy for global liquidity, yet it possesses deep structural ties to the core of the global AI and semiconductor supply chain. Currently, we are observing a stark divergence. Macroeconomic headwinds driven by a hawkish Federal Reserve are clashing directly with robust micro-level fundamentals, specifically in K-Tech. Today, we will dissect this divergence and outline our actionable allocation strategies for the next 24 hours. Let us first address the macro trigger. Following Chairman Kevin Warsh's debut FOMC, forward guidance was abruptly dropped, and the revised dot plot indicated surging probabilities for a 2026 rate hike. Consequently, the two-year Treasury yield spiked to 4.21%, and the dollar index surged past 100.4. This strong dollar environment traditionally creates severe valuation headwinds and triggers passive foreign outflow pressure for emerging markets, dictating the initial downward trajectory for the KOSPI index today. Simultaneously, we are pricing in a massive geopolitical shift. The landmark Memorandum of Understanding between the U.S. and Iran entails a ceasefire and the full reopening of the Strait of Hormuz. This unexpected resolution significantly dampens energy-driven inflation expectations. For the equity market, this triggers an immediate sector rotation, accelerating capital flight away from traditional energy and refining assets. Translating these macro shifts into intraday microstructure, we categorize today's KSOP price action into distinct phases. We anticipate Phase 2, an initial gap-down shock of roughly 1.0% to 1.5% at the open. This is driven by retail panic selling, directly correlated to overnight U.S. tech weakness. However, we project a rapid transition into Phase 3, the reevaluation stage. Solid earnings visibility in domestic tech sectors will act as a structural floor, initiating market stabilization, primarily driven by foreign institutional futures covering. A prime example of institutional arbitrage happening beneath the surface is observed in Samsung Electronics. We are tracking a severe divergence in smart money flow. Foreign investors are currently offloading Samsung common shares while aggressively accumulating preference shares. The preference shares currently trade at an extreme 33% discount to the common stock. Factoring in anticipated special dividends driven by record free cash flow, the preference shares offer a compelling arbitrage opportunity, with potential yields approaching 10.1%. Moving to our core conviction, the structural decoupling of K-Tech from macroeconomic noise. Despite global volatility, Korean semiconductor leaders are securing definitive profit visibility through long-term agreements, or LTAs, with global AI giants. This transition from cyclical spot pricing to fixed long-term contracts fundamentally alters their valuation framework. SK Hynix reaching record highs amid broader market sell-offs perfectly illustrates this highly robust fundamental floor. Beyond semiconductors, Korean biopharmaceuticals are facing a massive regulatory tailwind. The U.S. Senate's progression of the Biosimilar Deregulation Act aims to abolish the costly interchangeable clinical requirement. This structural shift drastically slashes R&D costs and accelerates the U.S. market penetration rate for top-tier Korean biosimilar exporters, presenting a significant long-term upside that is currently underpriced by the broader market. Examining liquidity flows reveals a distinct contrarian indicator. We have tracked 1.7 trillion won flowing into highly speculative, unprofitable space ventures, funded simultaneously by a 1.5 trillion won retail outflow from foundational semiconductor leverages like SOSL. This profound noise trading and retail herding dynamic creates optimal entry points for institutional capital to accumulate undervalued, fundamentally sound memory stocks at discounted valuations. To synthesize the information cascade, the hawkish Fed and DXY spike act as the primary downward pressure on the broader index. Conversely, the Iran MOU triggers tactical balloon effects, punishing refiners while presenting tactical opportunities in reconstruction. Concurrently, U.S. regulatory relief provides an immediate, isolated boost to the K-Bio sector. Our strategy relies on navigating these distinct crosscurrents rather than trading the index outright. Our 24-hour Bayesian probability model assigns a 60% likelihood to our base case, a 1.0% to 1.5% KOSPI gap down that finds support, buffered by resilience in the semiconductor index and exchange rates stabilizing near the 1,380 won Korea won threshold. The bear case, at 30%, involves an uncontrolled DXY surge forcing over 10,000 contracts of foreign futures dumping. The bull case, at 10%, requires the oil plunge to completely neutralize the hawkish Fed shock intraday. Concluding with our actionable allocation strategy, we are overweight on memory semiconductors backed by LTAs, K biosimilars capitalizing on U.S. regulatory shifts, and Samsung preference shares for dividend arbitrage. We remain neutral on Middle East reconstruction and domestic financials, which act as inherent rate hike hedges. We are strictly underweight on the energy sector due to the Iran MOU, alongside highly speculative technology ETFs. This concludes our strategic overview and execution plan for the Korean market today. We will now open the floor for any questions regarding execution logistics or specific portfolio hedging parameters.